Welcome to the UK Stocks I'm Buying August 2025 edition, and we're back on the whiteboard. It feels like I don't use a whiteboard anymore. I'll be honest with you, the reason why is my feet just start hurting after talking for about 10 minutes, so I prefer to normally sit down and do the chats about the stocks, but yeah, we're back on the whiteboard. Welcome to the Stocks I'm Buying. We've got 14 stocks on the list today. The reason why there's so many is I just think, so these are the stocks I bought between the 1st of July to the 1st of August, and also the stocks that I sold. And I think what we just had is a bit of negativity into the UK market. I think it might have been fear around the economy, the current government, the cost pressures they're putting onto businesses, potentially the budget that's going to come up in autumn, and the fear that more taxes are going to come in on a lot of these businesses that have already been hurt from the current government, and obviously the change that the previous government made as well during that time frame. And I think it just built up a negative sentiment, and we saw so many stocks have a big dip between the 1st of July to the 1st of August. So I was pretty aggressive buying into some of these UK stocks. So I'm going to go through the list. Some of them have kind of stayed at levels that I bought them at. Some of them have rebounded from the lows, and I'll point them out to you which stocks have rebounded and everything like that. But yeah, hope you enjoyed the video series. It's a video series that I do every month just to kind of build up that transparency. So any UK stocks that I buy, they're always on this video series. You can go back 5-6 years and now see what stocks I've been buying, and you can see if they work out. You can judge me. Don't try hide anything. They're all on here. And also any stocks that I sell, they're always on these videos as well. So anything that has worked out and I've sold, I'll let you know. And obviously if anything hasn't worked out and I've had to sell it for a loss, it's also on this video series. And I think that's why people like it, is that you can just track along with what I've been buying, what I've been selling, and everything's on here for you guys. Not many YouTubers are out there with that transparency of everything they're buying, everything that they're selling. So hope you enjoy the series. Apart from that, hit the like button, subscribe. It's going to be a long one. If you could just share it a few places for the amount of time that this is going to take to record and edit, that would be absolutely amazing. Let's get started. Now, just a quick shout out, as always, if you do want to know what I'm buying and selling in real time, then the place to be is on the Patreon. I post my live buy and sells in the Patreon and the private group. So if you do want to join, links in the description. £6 a month, or if you do sign up yearly, you do get it for a little bit cheaper. I think it works out as like £5.20. And as a thank you for supporting the YouTube channel and all this content that I give you guys, I also give you 2 exclusive videos on the Patreon as well, and Discord with 600 members on to talk about stocks, including me. So if you do want to support the YouTube channel, guys, there you go. And also, if you do want to start investing, join eToro with the link in the description, and you can go and buy and sell stocks on the eToro platform. Number 1, Warpaint. So number 1 is going to be Warpaint. I think this stock, out of all the stocks on this list, and there's a reason why I put it as number 1, is this one has just fallen out of nowhere in the last month very aggressively, and so quickly has gone to a point of view where it's gone incredibly cheap. I don't know why Warpaint has fallen that much. It's at the point where Warpaint has fallen that much where I'm like, does the market know something that we don't know? That's the only way I can kind of get why Warpaint has fallen this much. If there's no issue around the business, then this is looking an attractive time to be buying Warpaint, in my opinion, and that is what I have been doing. You can see here, really from July time, the stock just fell 25%, and we are now actually lower than where we were when the whole tariff situation was happening, and Warpaint has now fallen back to prices it was at around about, let's keep going here, October 2023. So yeah, significant fall. 3.5% dividend yield as well, which is really nice to receive. And I'm sure you know what Warpaint is. If you don't, I'm sure if you go through your missus's makeup products, you probably see a few Warpaint products in there. They own W7. They also own another brand called Technic. You might recognize some of these other brands, but those are the 2 main brands in their product portfolio. Makeup brands, and very good products, cheaper products, sometimes do dupes as well, and that gets people onto the Warpaint brand that they currently have. Now, I have got slides from the 2024 interim results. The full year results, the presentation just wasn't loading for some reason. But you can see here from them interim results, which was about a year ago now, they had revenue growing at 25%. Gross margins is increasing as well, up 334 basis points. They basically got to a point a year ago where they got rid of a couple of sellers that were selling the products for weaker margins, and then they switched to some higher margin products, and now they're getting the rewards for that. Profit before tax was up 76%, growing faster than revenue, and you can see here they hiked up the dividend significantly. One thing is their UK is growing at decent rates, but the international is where the big exposure is, especially into the US. Part of me thinking is as they get more US exposure, and the TAM is, I think, 10 times the size of the UK TAM, will they be tempted to go for a US listing? Also, is there going to be someone at the moment that's looking at Warpaint and looking at how successful they're doing? Still relatively 250 million market cap, looking at the share price fall and thinking, you know what, I could throw a £6 bid on here and let's see if Warpaint are going to be tempted to take it. And I think that could also be a case that's happening with Warpaint at the moment. We never know, just something that I'm thinking here. You can see here W7 brand sales have been up 25%, Technic sales up 34%, and also a lot of new partnerships as well that they're launching their product in. Now, that was a year ago, so this is going to the AGM statement that was posted on the 17th of June. This is the latest information we have from Warpaint. We do get another update from these guys in September, I believe, but they did do a bit of a trading update. So you can see here, the group continues to trade robustly with sales for the 6 months to 30th of June 2025, expected to be in the range of 50 million to 52 million. So the prior 6 months was 45 million, so a decent increase there. They did make an acquisition of Architects, which was about 5 million. So with that 5 million on top, you can see the growth has slowed down a little bit because a lot of that growth has come from the contribution of the acquisition. They said here that the group's revenue in Q2 has, as expected, been impacted by a slowdown in the US business, which remains a modest proportion of group sales, 2024, 8.4%. Following the rates of the higher tariffs, however, group sales overall are being achieved at a significant higher margin than achieved in 2024. So they're saying, look, we're going to see gross margins come up again. So you're going to see the profit grow faster than revenue. They said that even more so than previous years, the group expects sales for financial year 25 to be heavily second half weighted, because obviously that's when you get the Christmas sales come in. Also, what you'll have is the new store launches. And what you'll see is when they do the restocking, so the restocking of the shelves that happen in these stores where they get the more of the products in these supermarkets when to see which ones have been selling well in the last year happens. The shelf resets happen around April, May time. So that's when they start coming into like June, July time as well. So that's going to be obviously a big thing for them. This is due to the large number of planned product rollout additions stores in H2 as previously announced. Together with a significant Christmas order book, there continues to be substantial growth opportunity for Warpaint, and the group is very well positioned to achieve future growth with additional improvement for margins. The board remains confident that the group will meet market expectations for the year end 31st of December 2025. So they're saying a little bit of a slower start, so you could see why the stock maybe got a bit nervous on that point of view. But you can see here, still expecting full year guidance, as we know H2 weighted, and we can see here margins are still growing faster than profitability. So when you're looking at Warpaint, in my opinion, you're seeing a stock now that really peaked in July 2024 and now it lost half its value. I don't think that should happen for an update that said things have been maybe a slightly bit slower, but we're still on track for full year guide and margins are going to grow faster than the revenue. Doesn't really make sense to me. I look at the company as well. The company is trading at 11 times 2025 numbers, which we're basically getting towards now because we're 4 months away from the end of 2025 now. So this is 11 times earnings for this business. And if we look at next year's numbers, which I like to do now because we're only getting 12 months away from 2026, 10 times earnings. I mean, look at this company here, 46 million, 50 million, 89 million, 121 million. 137 million. Look at net profit. 1 million, 2 million, 6 million, 13 million, 18 million, 20 million, 21 million. That's insane numbers. So good. Like Elf Beauty in the US is trading like 30, 40 forward times earnings. And Elf is just doing, Warpaint are doing just as good numbers as Elf Beauty. And it's a third of the valuation. It just doesn't seem to make sense. And as well as that, they've got a good balance sheet. I mean, look at the balance sheet. I don't think this is including the acquisition on top here, but such a strong balance sheet as well. And they're so highly profitable as well. When you look at the company as well, they've got very decent profit margins as well, 17% for a makeup brand. I just don't know why this has fallen so much in the last couple of months, especially this last month. So yeah, I am buying Warpaint quite aggressive at the moment, and that's why I've actually decided to put that as the number one starting stock for this video series. Number 2, Zotefoams. So I did buy some Zotefoams. The problem is this is one of the stocks that I started buying in July time. And as you can see here, the stock has rebounded. The stock has bounced up 40% since that time frame. So just make you aware of that. But I was buying Zotefoams. Once again, this was a stock that, a bit like a Warpaint that we were just on about, like the stock just started dipping out of nowhere. It had like a 15-20% dip. And why is it dipping? I don't know if it was nervous around the earnings coming up and the tariffs situation maybe affecting it. Don't know. I was at the point where, a bit like what we were speaking about Warpaint, I was like, does the market know something that we don't know? And it turns out it was just being stupid because the stock rallied up. They did a ahead of expectations trading update. And yeah, really happy. Those shares that I've been buying are already up 40+%, which is great. If you don't know what Zotefoams do, they're a seller of foams. One of their big clients and products is they sell foams to Nike, and they do the foams in the running shoes. As we know, Nike are generally known as having the best running shoes, and if you look at Nike, they've had a horrible time. But the one part of business for Nike that's actually been doing really well is their running shoes. So, and Nike have exclusivity over Zotefoams and their foams, which is great. And they're also launching a new factory in Vietnam to get closer to Nike, coming up as well. They also have other foams that are in like the likes of EV vehicles, constructions. They've got a big deal with Airbus and also Boeing. So yeah, they've got major growth drivers going forward. They've got a new CEO in. The new CEO has got to a point of view where he's prioritizing partnerships like Nike and also focusing on profitability. And because of that, we saw in the latest updates, which were just absolutely fantastic. Sales were up 9%, but gross margins were up 140 basis points. And that's where you started to have profit going up faster than revenue, and EPS as well going up faster than revenue. And realistically, before the jump, this company was on the 2026 numbers. You were able to pick this up at 9 times earnings, which was just incredible. It was like what we were just speaking about, Warpaint. Should happen. Now, even right now, you do look at Zotefoams and it's only 12 times forward earnings, which if you're thinking about in a year's time, I think this company could be like 17, 18 times forward earnings. So it's not actually still like overvalued, even though it's been on a decent run. It's still pretty decent value. So yeah, I'm still holding a lot of my shares for the long term, but obviously I was buying a little bit cheaper, but I was buying some Zotefoams. Moving to number 3, Audioboom. This one is volatile. Seems like there's a lot of battles between short sellers going on in the moment. I mean, if you just look at this last month alone, down 11%, up 18%, down another 11%, rallied up 24%. So yeah, when Zotefoams is majorly volatile and when it does start having some of these, I mean, even if you look at this here, up 54%, down another 50%, up 43%, down 30%. Yeah, it's crazy. So yeah, when Audioboom starts to have these dips here where it goes into those £2 ranges, I add into my Audioboom position, and that's what I did. I started buying around July time. We entered the £2 range again, even though it's already back up to £4. So this is one of those that I've bought and it has rallied up a little bit since, but I was buying Audioboom. If you don't know what Audioboom is, they're basically a podcasting company that links up podcasts to their audience and then also advertisers and links it all together. They are at the moment not growing as fast because they have cancelled a few unprofitable contracts. The main thing they're focusing on at the moment is profit. So when you start looking at the profit, that's where you're seeing the big surge up. So you've got the likes of gross profit up 30%, you've got EBITDA up 500%. And what will happen eventually is that revenue growth will start coming back, and also with the acquisition they've made as well. But the key thing is how fast that profit's ramping up at the moment. Now, there's a couple of reasons why the profit is ramping up. Like I said, they had some contracts they're getting rid of, which were bad contracts for them, loss-making contracts. They had some Apple changes to come over, and then they had the recession in the media space that they've kind of come over. The other big thing they have as well is they've got a new product, which is a little bit more of an AI product, which is this Showcase. This Showcase platform that they launched a couple of years ago has 30% gross margins. This is significantly higher compared to their other products that they have, which is Sonic and Premium. Sonic has 15% gross margins and Premium has 20% gross margins. So as you can see here, this AI product, which basically links up the advertisers to the podcasters a lot quicker and better and faster. This has, in either double or significantly bigger margins of profitability that they make on this program, and it's becoming a bigger part of the revenue. And the more that this becomes a bigger part of the revenue and people use Showcase more and more, obviously a lot of that is just basically going to the bottom line. I think there's literally 30 people that work for Audioboom or something like that. I don't know if it says on Google. Oh, 42. It wasn't a bad guess, was it? So basically any of this that's extra profit that's coming in is basically coming to the bottom line. And that's where you're starting to see adjusted EBITDA starting to 6x since last year, which is obviously great to see. And Showcase, as you can see here, is growing 24%, which is the main platform. They did make a acquisition of Adolicious, which between the 4th and the 5th biggest UK market provider in this space should put them to number 2 in 2026, and they are aiming to come the number 1 in 2030, and also a big expansion into the US at the moment. They do trade on 18 forward times earnings on the current numbers. I think it's probably a little bit lower because I think they're going to come, because profits ramping up that fast, I think they will come ahead of market expectations. But 18 times forward earnings for a company that's growing the EBITDA at 6x because of this profitability surge, I am quite a big of the fan of the company. But also, as like I said at the start of the video, I was personally buying this slightly lower before the rally that it's been on. I think I was buying this at about 14 forward times earnings, which obviously 14 forward times earnings is significantly lower and does look very good value when you do look at that point of view. So yeah, I was buying a bit of Audioboom. Moving on to the next one, which is one stock that hasn't been rebounding in the last couple of weeks, which is B&M. So B&M has fallen back down. Previously, I was buying in this sort of range. We had a bit of a rally up. Last time I think I talked about B&M is that I actually trimmed my position slightly. So I was up like a 20%, locked in some profit. Not all my position, about 8. I think I've trimmed like 5-10% of my position. And I said, look, it's a quick, nice bit of profit. And what that will allow me to do is if the stock goes down, I can put the money back in from the profit that I've taken and buy more shares and buy them at a lower average. Or if the stock if this doesn't go lower and the stock did carry on going up, then I still hold 90% of my position and I make money from the long term. So that's how I always position myself, that I make money both ways. And in this case, we ended up the position where the stock continued to go lower. So then the money that I'd taken out for a bit of profit, I put back into B&M. Fallen to the £2.22 range, which is incredible. I did not think we would hit 52-week lows after the latest update. B&M now is lower than where it was during the 2022 Russia-Ukraine situation where the stock market crashed. And we are actually lower now than the whole COVID situation where they had to shut all the shops down, which is incredible. It's actually lower now when it IPO'd on the market as well, which is, yeah, insane. So, yeah, I think this is way too low for B&M. You're getting a dividend yield of 6.6%, which is lovely. Nearly higher than the P ratio. It's not often you get the dividend higher than the P ratio. Normally, it's a point of view where the reason why is because they're going to have to cancel the dividend. But in this case, they don't. They can easily carry on paying this dividend. The dividend's covered by 50% of the earnings. B&M, I'm sure you know B&M if you're from the UK. Great stores, loads of great products. If you go there, you end up thinking you're only going to go buy one thing. Next thing you know, you spent 30 or 40 quid when you go there. I found out the hard way at Christmas when I was buying a couple of Christmas presents in B&M. Next thing you know, I've spent about 250 quid in B&M on Christmas presents. But probably one of the only retailers that has the social media following that B&M does have. If you ever go onto YouTube and you were to search B&M, you'll see that there's the autumn collection videos here with 6K views. If we scroll down a little bit here. Huge new B&M store opening from this one here, which is 3 weeks old, which is about 10K views. So yeah, people really enjoy going to B&M. They make videos about it. Something that I've never seen before, and people get really hyped up about their their autumn collections, the summer collections. So yeah, hopefully that continues and they keep tapping into that kind of space, and people do like going to B&M. Now, they came out with the recent earnings, which was their first earnings under their brand new CEO, which looks like he's doing a very good job. I told you guys a while ago, I asked him to come on the YouTube channel. I've not heard a response. I've gone with a follow-up email yesterday. I'll see if I get anything back. But yeah, this is what I can't get. Like, B&M continue to drop here, and yet the latest updates was a good step in the right direction, in my opinion. You had B&M UK still growing, you had B&M France growing really well, group revenue up 4.4%, like for like went back up to positive growth here. A really good step in the right direction. Yeah, we'd like it a little bit stronger, but it was still okay. And this is what I don't get with B&M, is like the earnings were okay, and you got to put it into context. Like, it's a 7 times earning business getting a 6% dividend yield. I don't know what the market wants. And through all of this situation here where the stock has fallen massively, obviously I won't buy in at the £5 range, but this big 63% drop the company's had. Yeah, B&M has had some issues. They have had a couple of little profit warnings, but a couple of profit warnings where you downgraded the profit like 3%. Doesn't justify where a stock falls 60+%, and you don't get to a point of view where your dividend yield is nearly higher than the P ratio when it's a sustainable dividend. They're absolutely scary to me. But anyway, I'm going to keep this nice and brief because I did do a B&M video that was 16 minutes long on YouTube about a month ago, which goes into it a little bit more detail than what I will today. But yeah, I just look at B&M and on a forward basis, we're at 6 times earnings. We're going to go lower than dividend yield. It doesn't make sense. Like, B&M for me should be a company at 12 times earnings. They've had a few issues, yeah, but it's nothing like what the share price is pricing in. Hopefully the CEO can get things going. New CEO can get things going in the right direction. It kind of, from the update, it looks like he is kind of doing that at the moment from some of the changes making in the product mix at the moment. So yeah, I like B&M, so buying that one. Moving on to the next one, Card Factory. So this is another one that has kind of had a bit of a bounce since I started buying. Card Factory did get to the 80p range in the middle of July, so I did start buying into it. Since then, it has had about a 20% bounce. I still think it's quite cheap, to be fair, in my opinion, but I won't buy in at the £1 range. But yeah, the 80p, I was like, yeah, I'm going to have to come in and buy some more Card Factory. Don't know why it was one of those that just had the drop out of nowhere. So yeah, bought into it. A little bit of a bounce, like I said, but yeah, big fan of Card Factory. Getting lovely 4.6% dividend yield to keep you warm while you're waiting. 7 times earnings. Like, this company has actually had no financial issues, and 7 times earnings for this. Like, same again, this should be a 13, 14 times earnings business. Card Factory, I'm sure you're aware of Card Factory once again if you are from the UK. They're going to continue opening up new stores, but there's other things going on with Card Factory. So they've got like partnerships with, what is this advert? They've got partnerships with like Aldi at the moment, and the big thing they're doing at the moment is expanding through these sort of partnerships. They have also bought Funky Pigeon, so this is going to help them in one of the big criticisms from Card Factory is that they're quite far behind on online sales, but hopefully this Funky Pigeon acquisition is really going to help them catch up a bit as well, which should be good. The thing as well is that they should make Funky Pigeon quite a profitable business, because obviously they've got all the facilities for making the cards already, have Card Factory, so this could be quite a profitable business for them as well. And yeah, they did a trading update, and the trading update, once again, this was only a while ago, and it was great. Still expecting mid to high single-digit % growth here at the moment. They expected a profit before tax to be unchanged as well at the moment. Waiting, as typical for a company like this, stronger second half because of the Christmas period. And I mean, same again, like, look at the financials of the company, massively going up in the right direction. Look at the rebound they've had on financials since the COVID times, and 6 times earnings. This was a company that previously was an absolute mess on the balance sheet, so much debt, and they've got the balance sheet back into a strong place where they can go make these acquisitions like Funky Pigeon as well. And yet it's a lower P ratio than what it's historically been. The share price has been stagnant for a while, and it's still way below where it was before COVID. So yeah, you know what? It's had a bit of a rally up in the last few weeks, which is good, but I still think it's pretty cheap at the moment as well after all that rally that it's been on. So moving on to the next stock, it is Hollywood Bowl. I've got to say, I've been a shareholder from Hollywood Bowl for quite a while. One of the stocks I started buying during the whole COVID situation. Still own a lot of my shares, up 157% on some of those shares, but recently the stock has been having a bit of a dip. You can see here the stock peaked around April 2024, and since then the stock's down about 26%, and I'm averaging up. I look at the stock, I think, you know what, I like the value, I think I can make more money from buying at these sort of prices, and that is what I'm doing with Hollywood Bowl. Don't know why it's dipping, because I think the company has been doing very well recently. Saw Paul Scott the other day made a great point that maybe because of all this warm weather there could be a profit warning coming up, because obviously you don't go somewhere like Hollywood Bowl when it's nice and warm. You normally go when it's a wet summer and it's been really warm, so maybe a bit of a profit warning. But looking at what it's fallen and the valuation it's at, it looks like it's probably priced some of it in, or priced it in. So right now, dividend yield 4.8%, which is a lovely dividend to receive. I'm sure if you're from the UK, you have a Hollywood Bowl near you. Bowling alleys, they have arcades, and as well as that, they have bars. So free income streams. They place them in very good areas. These places where there's like a couple of restaurants, a cinema. So you go for a day out, you might go to the cinema, then you might go and do a game of bowling, or you might do a game of bowling and then go to the restaurant nearby. So really good locations. And like I said, the recent earnings were good. Revenue was up 8.4%. If you look at H1 EBITDA, it was up 8.8%. The bottom line profit did get hit slightly because of a few one-time charges and also the timing of Easter, like that. But apart from that, everything's still moving up in the right direction inside the business. UK revenue grew at 4.7%. And if you look at the Canada, which they're currently expanding into, they've been expanding into Canada the last 3 years and trying to copy and paste the business model into Canada, and it's seen a lot of success. That is currently up 40%. They're targeting from the UK to get to 95 centres, and if we look at Canada, they're currently looking at getting to 35 centres, so doubling the amount of centres they currently have in the next 10 years. If they do that, I think that will lead to significant amounts of revenue and profit that will hit the bottom line. And right now, you're currently buying a Hollywood Bowl at around about 10 times forward earnings. Normally, a company like Hollywood Bowl, this is a very, very high quality business on the UK market. Great growth, great track record, great dividend, great balance sheet, 10 times forward earnings. You normally talk about Hollywood Bowl probably being like 18 times earnings. So yeah, if it grows into this valuation in the next 12 months, I would say that you could argue there's 80% upside if they do go to the right valuation in the next 12 months, which is obviously pretty significant. And also you're getting that nice little dividend as well on the side. So yeah, big fan of Hollywood Bowl. Moving on to the next one is Catebox. So Catebox is one of the stocks that has had a bit of a bounce since I started buying in July. The stock was around about £1.79 in July. I think I even made a video after the reported earnings going, guys, you got to look at this stock. I don't know if it was on the main YouTube channel or the Patreon, but I was saying like these earnings were fantastic. And the fact that this is £1.79 is just incredible. It's had a bit of a bounce up since, although recently it's had a little bit of pullback. But yeah, it's paying a 5% dividend yield, so a lovely dividend that you get from this stock while holding it. Catebox is a supplier of cakes, birthday cakes, also other special occasions, but also you can go into the shop and buy slices of the cakes. Don't know if any of you guys have actually tried the product. In my opinion, it's probably the best cake I've ever had. They're absolutely fantastic. I love them. There are quite a few people in my family that I've got them to try the cakes when we're out and about, and then they've come back to me and gone, oh my days, these are amazing. And they've actually turned around to me now and they've gone, I want a Catebox cake for my birthday cake, which shows you how great the products are. Like I said, the recent financials were incredible. The fact that how low this was, revenue growing at 13%. You had underlying EBITDA at 17%. Obviously, there's a couple of acquisition costs at the moment. Profit before tax was down slightly because some of the investments that they're making. If you do look at underlying profit before tax, which is probably the better number to use here, up 17%. So you got profit growing faster than the revenue as well at the moment. So that's great to see from Catebox. And right now, the company is 12 times forward earnings. So yeah, 12 times forward earnings for a company growing double-digit growth and the profit actually growing faster than the revenue here, and you get a 5% dividend yield. Yeah, I thought Catebox at the £1.80 range a couple of weeks ago. Yeah, really, really big opportunity. So I was buying into some of the Catebox when that was happening. Staying in the bakery section, we're going to move across to Greggs. So Greggs is one of the stocks that hasn't recovered. Basically stayed flat through most of July, as you can see here, into August. I'm happy to carry on building up the position into Greggs. Had a significant pullback. Not often you see Greggs when it's having a 50% pullback. That's more than the pullback it had during the whole 2022 stock market crash, and I believe it's very close to where it had the dip in COVID. Yeah, so COVID was just 2% more than the current dip it's been on. So every time this stock has had a 50% dip, always seems to be a good buying opportunity in Greggs. You do get a free 4.3% dividend on Greggs. I'm sure Greggs is a new one that everyone can knows on the high street. I'm sure you have quite a few near you as well where you do live. One of the fears that I have seen around Greggs is that they're just saturated. There's just too many Greggs, which I just don't agree with, because if that was the case, they won't be growing revenue at the rate they are doing, with sales up 7% and like for like up 2.6%. So there's not really much of a sale issue that I'm seeing at the moment with Greggs. Obviously the big thing that you have is profit isn't moving up like revenue. And in my opinion, what's going on with Greggs at the moment is they've just had like a perfect storm where everything that could go wrong has gone wrong, and it's impacted them. And I think they'll bounce back from this situation. So they've had a bit of warm weather, so that's hurt them a little bit from the footfall and people going in and buying like the likes of the pastries, for example. Obviously, I'm sure we're all aware of the increases in NI at the moment. To combat that, they're trying to move to machines when you order food, so less staff you have to pay for. You've seen the videos of people probably stealing things at the moment. Obviously, one thing they're doing to combat that is to move all the products behind the counter. And then the other thing they have is they're doing a lot of investment. So they're building a lot of factories at the moment, and they're going to come in the likes of 2026, 2027. So that will probably help the profit margins further down the line. So just the whole combination of these factors has led to a point where Greggs has fallen that much. And I think a great company like Greggs will rebound back, and we'll see Greggs start increasing that profitability again. 12 times forward earnings. Greggs has historically been at least 20 times earnings, sometimes 25 times earnings. I think that's a bit too rich for a company like Greggs. But yeah, shows you how much the company has fallen down here. And while you wait as well, you get that lovely dividend there. And you can use that dividend you get every year to go treat yourself to a couple of sausage rolls a couple of times throughout the year. So I'm a big fan of Greggs at the moment. Next one, Mobico. So Mobico's had a bit of a bumpy time, to be fair. During July, it had a pretty significant dip into the 28p range that I was buying. It's had a rally up since that time frame, even though still at the moment, I think Mobico's still not too bad value, to be fair. The stock has just had a tough time since 2021, down massive. It's priced lower than where it was before the COVID situation. It's now lower than where it was when it came onto the stock market. And Mobico is just being valued like it's going bankrupt, even though it's come out and said like we've got enough cash for the next 2 years. And I actually think there's some parts of the businesses that are actually really good. So one part of the business they have is this ALSA business, which is like in Europe. And that part of the business is the biggest part of the business. It's still growing at really good rates, 13% growth a year. And you look at profit, significant amounts of profit, 186 million of adjusted operating profit, growing at 36%. The North America part of the business, that's still doing quite well at the moment. But the problem they have is they've got a UK business that's been very poor and a German business that's been very poor for them. So they've got to kind of work through this UK-Germany business. But the stock seems to be getting valued so low because of those two parts of the business. And it's like, well, hold on. Why is the stock getting valued off these two parts of the businesses that aren't performing well? But these are the smallest parts of the business. Now, you look at this ALSA business, somebody would be willing to pay for 1.3 billion in revenue and 186 million of EBITDA of profit. Somebody would be willing to pay, 4 or 5 times operating profit. So if you do that, you're on about 900 million for that multiple, right? And then you look at Mobico, and it's currently 208 million. And one thing that I think a few people talks about this, the getting a bad price for the US school bus business for 608 million. I think that was a cracking price. When you're getting it for 608 million for one of the worst parts of your business, and it's 3 times your current market cap, that's a good sale in my opinion. And I think a few people are getting a bit caught up because it looks like it's loss making. when realistically it's not loss making. It's just because they've got to take the depreciation charge on. If you take that out, the company is actually still generating profit. You look at EBITDA here. EBITDA increased from 386 million to 426 million. Same again, EBITDA is currently 2 times the market cap of Mobico. I don't think I've ever seen a company trade at 0.5 times EBITDA. It's just so low. If you look at free cash flow, let's have a look at free cash flow. So free cash flow for the last year went from 163 million to 210 million. Same again, I don't think I've ever seen a company trade at 1 times free cash flow. The balance sheet's an absolute mess with this one, but there's still good parts of this business. And you look at the value it's trading at right now, I just think I just don't know why it's gone this low. So yeah, messy balance sheet, but I still don't mind picking up some Mobico. Next one, Eurocell. So I did buy recently through Eurocell, but one of my concerns with Eurocell is that I think when I'm looking at a lot of these companies that report in this house builder market, home improvement market, it seems like we're starting to see the recovery happen in like the concrete bases and what products you would use for the start of construction of the houses. So I think we're starting to see the recovery from that point of view, but the kind of home improvement market and the kind of end stage of the construction still seems like it's quite a fair bit off the moment, but eventually that will filter through. Eurocell, I'm willing to be quite patient on it because I think when the market does turn, this company has made a lot of improvements in the last few years to be a company that does capitalise on the recovery of the home improvement and the UK housing market. If you don't know what Eurocell is, they do sell a lot of building products, as you can see here. And even though it's been a bit of a tough time for them, revenue was down 2%. They still managed to increase profit by 32% because they are managing costs that well. The only thing to be careful of is that obviously when you are increasing your efficiencies that much, eventually it might come back and hit your customer service part of it, but obviously still managing the costs really well, which is really good to see. They've got 5-year ambitions of getting to 500 million in sales and a 10% operating margin if they're able to do that. Few ways they're going to do it is they're going to increase their extended living, more branches as well, improve their website and more efficiencies like we've kind of seen them do already. Some things that they're doing at the moment, so they did launch in Q4 2023 into this extended living update. So previously what we saw is this, a lot of people started to get conservatories in the kind of early noughties. Now what people tend to go for is what they call these like new build rooms, which are more like efficient for like wintertime. So if you ever had a conservatory now or when you're younger, you probably realise like in the summer, yeah, it's great, it's very warm, but as soon as you get to the wintertime, nobody goes in the conservatory. So people are building more of these rooms that can be used all year with a kind of the roof on there, a bit more of the walls, the open sliding doors. And you can see here the sales performance since they launched it, 0.1 million in 2023, and in the last financial year, that increased to already 1 million, which is great to see. And as well here with this garden rooms that they also launched as well, and that's been a great growth driver for them recently as well. So hopefully, as we enter further down the line and the recovery starts happening, they have the facilities in place where any new products that are sold out of the store will just end up going to the bottom line. So when the growth does start coming back and they go up in the right direction, you can see here net income or net profit is expected to move very much in the right direction. That'll end up hopefully in a point of view where in 2026 Eurocell is trading about 6 times forward earnings. So if that does happen, yeah, I think Eurocell probably would end up being about 12 times earnings business, which would be obviously a double up from where it's at right now. So we'll see if Eurocell do get that tick up when the home improvement market does come back. Next one, I'm going to do these ones together, which is Barrett Redrow and Taylor Wimpey. Obviously, both house builders, which is a good timing following on from Eurocell. At some point, the housing market, new builds will come back, in my opinion. Obviously, the big thing we look at is interest rate cuts. If more and more interest rate cuts happen, at some point that will lead to the built up demand of people wanting to go buy the houses, and obviously we see that the amount of people that are needing to own a home, the shortage that we do have, there's all this build up where people have been buying less houses in the last couple of years, so eventually that will end up to a point of view where these house builders will see the surge back up in demand here. With Barrett Redrow, what I like about Red Row is obviously they've combined companies. If they're able to get to the old profit margins they used to do, and they also have the efficiencies that they said they can achieve with the crossover between Barrett Red Row, this could be a point where Barrett Red Row used to be a company that was around about a £5, £6 stock, but then obviously with the efficiencies on top, I could see at the point where Barrett Red Row comes like a £6, £7 stock, and obviously you get a lovely dividend from it. Taylor Wimpey I like because you get a bit more of a chunky dividend from Taylor Wimpey at the moment. So yeah. Good house builder as well, good reputation, good valuation. So yeah, I mean, Taylor Wimpey is actually the same levels as it was nearly during the 2022 timeframe. So yeah, adding into my house builder stocks, I've got to say I've been very tempted to add in MJ Gleeson recently as well, which I actually haven't done. So yeah, big fan of that one. And moving on to the next one, we've got Watch the Switzerland Group. So Watch the Switzerland Group is a stock I actually started buying in 2024. This stock ended up going on a pretty decent rally, sold out of my position, and since then it's actually fallen down 43%. Same again, I don't know why it's fallen down, because you look at the finance, and it's been on a big fall as well, by the way, and continues to fall. So yeah, this is, in my opinion, still a good valuation, and even got a bit more of an even more attractive evaluation since I started buying it. But I don't know what it is with Watch the Switzerland. I assume it's a tariff situation, and that people are worried about the tariffs that are going to get put on to Switzerland potentially. But even so, at the moment, I think that, you know, it will get resolved, and I think they'll be okay. And I think the sell-off is just way overdone at the moment. Now, Watch the Switzerland, in case you don't know, they do sell the high-end watches, Rolex being one of the big ones. Rolex do not sell direct to consumer. The only way you can get a hold of Rolex is through a partner like Watches of Switzerland, and it is also one of the only publicly traded luxury watches companies as well. So technically, this is the only way you're able to invest into a company like Rolex. The company previously, Watch the Switzerland Group, was a stock that was around about a £13, £14 stock, now a £3 stock. They had a massive surge from COVID. Basically, as we know, people had a lot of spare money, interest rates were really low, people maybe buying watches that wouldn't normally buy those sort of end luxury watches, and then we kind of had the pullback in demand. And I think we're kind of stabilizing right now. And the thing is, we know with something like a Rolex, Rolexes only go up in value as well. So eventually the trend will go back into someone like a Watch of Switzerland's favour. What I like about Watch of Switzerland as well is they're expanding outside of the UK. They've been expanding into the US market since about financial year 28. You can see here the growth has been super for them. Look at the growth here, and now that has come about half. The US has come about half of Watch of Switzerland's business from where it was in financial year 19, where it's 24%. So, and it's only continued to grow, and this has actually performed very well for them. Considering where the current share price is, I've got to say, I do look at Watch the Switzerland Group, and I think, you know, would there be a point where somebody would be tempted to maybe, or private equity, to take this over, then spin it off in the US market in 2 or 3 years' time? But yeah, still financially performing quite well. I think we're down at a 7 forward times earnings. I mean, Watch the Switzerland, for a company that is really the only way that you're able to invest into Rolex, you know, this company should be trading at like a 14, 15 times earnings business. So, you know, once again, you're talking to nearly double up of the share price from where it is right now. So yeah, this is one I do really like. And the last stock on the list that I did buy is Bytes. But obviously, as you guys know from my video that I did on Friday, I did sell out of my position since I did buy, and I have moved it into a new company, which was in the week just gone. Just because I thought that was maybe a bit of a better opportunity. So I'll keep that one nice and brief. Selling wise, when we do get to the selling, there was only one trim that I did on the UK side between the 1st of July and the 1st of August. I have been, since the 1st of August, I have been a little bit active, a little bit more active. I have been doing a couple more trims. But the only trim that I did do was Audioboom. I did trim the position in Audioboom, as like I said earlier when I was doing the buying part. It's just so volatile. I mean, last year, you know, you're up 184%, and then you're falling down another 54%, and then you're rallying up, you know, another 40, 50%, and then after that, you're falling down another 20, 30%. So yeah, I mean, just alone, really, since what I just talked about there, you know, I was buying the stock after it fell about 30% from June to July time. And then as we go through July, the stock started bouncing back up again, and it's up 45% from literally where I bought a month ago. So with the volatility, I bought the shares. I decided, you know what, I'm going to lock in the gains, and made some a bit of a trim. Still obviously holding a lot of my shares because I do really believe in Audioboom for long term, but the volatility is making it easy for me to make some very quick money, and that's what I'm doing. So I did do a little bit of a trim in Audioboom as well, which worked out really well, to be fair. I do apologise, I actually did miss a stock I did sell when there was this many stocks on the list. I was going to miss one somewhere. I did trim a bit of my gaming realms as well. I think it was for about 45% gain, about 5% of my position. It's had a fantastic year. I just wanted to take some profit off the table. We're here to make money, so lock in a bit of profit. It has had a bit of a dip since, but nothing too major. But yeah, that was the main reason why. Just lock in some profit. We're here to make money. I made some money. The one thing that did also push me towards like trimming a little bit as well is they did do the last update, which I thought was actually really good. The only thing I didn't like is that they didn't upgrade the guidance. In that update, to me, it looked like they were way ahead of guidance. So I don't understand why they didn't do that. I guess as well, maybe something that's been brewing up recently, but this wasn't actually in my thinking when I did sell, is that we've seen the talks about tax hikes in the kind of gambling space. So that actually also adds into probably a good reason why I did sell. And in fact, maybe means I'd probably do maybe one more trim potentially going forward, which would be in next month's video. So we'll see what happens there. But yeah, that was the last stock that I did actually do a bit of a trim on as well. And that's all the stocks. It was a long one, wasn't it? I'll be impressed if you made it all the way to the end of the video. I tell you what, if you made it to the end of the video, I want you to comment in the comment box, jam donuts. If you comment jam donuts, I know you made it all the way to the end of the video. And credit to you guys. So I hope you enjoyed it. I don't think there'll be that many stocks next time because I don't know what happened in July, but there was just, you know, a bit of negative to where so many stocks dipped. But yeah, it was a busy one. I'm going to have to go get a drink of water. My throat is very dry after all that. But I hope you enjoyed it. Have a great rest of your Sunday, guys. And I'll see you all tomorrow. Thanks for watching. See you in a bit.